Everyone thinks the Iran crisis is over. The ceasefire happened, the market recovered, time to move on. They are completely wrong, and the people who believe that right now are about to get hit hardest. Here is what is actually happening. The Strait of Hormuz is still effectively closed. Ship traffic is running at 5% of normal levels. The CEO of Exxon Mobil just said 2 days ago that the market has not seen the full impact of this disruption yet, and he said there is more to come. Let me say that again. The CEO of the world's largest oil company said the worst is still ahead of us, and most investors are not paying attention because they think the ceasefire means it is over. It does not. Stay with me, because by the end of this video, you are going to understand exactly what is coming, why the market is dangerously wrong right now, and most importantly, which stocks will protect your portfolio and actually make you money when the second wave hits. If you are serious about not getting blindsided, hit that subscribe button right now. This is the research that matters. Here is what we are covering today. Why the ceasefire changed nothing for oil markets. The hidden time bomb in global oil inventories that is about to explode. Why oil experts are scratching their heads at prices that make no sense. What history tells us always happens next. And the 5 stocks positioned to benefit while everyone else panics. Let us get into it. First, let me show you what is actually happening right now that the media is not explaining clearly. On February 28th, the United States and Israel launched coordinated strikes on Iran. Iran responded by closing the Strait of Hormuz on March 4th. That single action took 14 million barrels of oil offline immediately. The International Energy Agency called it the largest supply disruption in the history of the global oil market, not the largest in recent years, in history. A ceasefire was announced on April 8th, and the market rallied. Investors exhaled. Problem solved. Except the problem was not solved. The Strait of Hormuz is still effectively closed, ship traffic has not recovered, and here is the detail that should terrify every investor who thinks this is over. The reason oil prices have not spiked to $150 or $200, as analysts predicted, is not because the supply disruption is not real. It is because the world has been burning through strategic petroleum reserves and emergency stockpiles to cover the gap. Those stockpiles are finite. They are running out. Exxon's CEO Darren Woods said this explicitly 2 days ago. 1 billion barrels of oil production will be lost because of this war. Current losses are between 600 and 700 million barrels. The stockpiles that have been cushioning the market will become exhausted, and when that happens, prices will increase sharply. The market is currently betting that Trump will end this quickly. That is a dangerous bet. Now, let me show you why this matters so much for your portfolio. Because the real threat here is not just oil prices. Think about what happens when oil goes from $110 to $150. And remember, that is not a wild prediction. That is what Exxon's CEO is warning about. Transportation costs go up. Everything that gets shipped costs more. Your grocery bill goes up, your utility bill goes up, manufacturing costs go up, corporate profit margins compress. And here is the one that keeps central bankers up at night. Inflation goes up at exactly the same time that economic growth slows down. That is stagflation, the same scenario that destroyed portfolios in the 1970s. And the Fed cannot cut rates to stimulate the economy when inflation is running hot. They are completely handcuffed. History tells us what this does to markets. The 1973 oil embargo caused a 48% decline in the S&P 500 over 21 months. The 1979 oil shock caused a 27% decline. These were not crashes caused by financial fraud or bank failures. They were caused by exactly what we are seeing today: an energy supply disruption that the market underestimated until it was too late. Now, I want to be clear about something. I am not predicting a 48% crash. I am not here to do doom and gloom content that gets clicks but destroys your confidence. What I am saying is that the market right now is pricing in a best-case scenario that is not supported by what the CEO of Exxon Mobil is telling us. And smart investors do not position for the best case. They position for the most likely case. And the most likely case right now is that oil prices move significantly higher before this is resolved. So what do you do? Here is exactly how I would position a portfolio for what is coming. Stock number 1. Chevron, ticker CVX. Chevron is not just an oil company. It is a cash-generating machine that has paid and increased its dividend for 39 consecutive years. When oil prices go up, Chevron prints money. And right now you can buy that cash machine at a 3.6% dividend yield. Here is the key detail. Chevron has been aggressively cutting costs. They hit $1.5 billion in structural savings last year and are targeting $3 to $4 billion by end of 2026. That means their profit margins go up even when oil prices stay flat. And when oil prices go up on top of that, the earnings acceleration is extraordinary. Buffett owns over 130 million shares of Chevron. He bought them before oil hit $100. That tells you everything you need to know about where smart money sees value. My concern: Chevron is directly exposed to oil price volatility. If a deal is reached and the strait reopens faster than expected, oil prices pull back and Chevron pulls back with it. Size your position accordingly. My takeaway: 39 consecutive years of dividend growth, 3.6% yield, cost structure improving every quarter, and oil prices about to move higher according to the CEO of Exxon. This is a strong buy right now. Stock number 2, Bloom Energy, ticker BE. Current price around $28. Most people have never heard of Bloom Energy, and that reaction is exactly why this opportunity exists. Here is the reframe. Bloom Energy does not depend on the grid. It does not depend on pipelines. It does not depend on the Strait of Hormuz. It generates power on-site using fuel cells. For AI data centers that need reliable, uninterrupted power, that is not a nice-to-have, that is mission-critical infrastructure. When the grid is stressed by higher energy costs and supply disruptions, Bloom Energy's value proposition gets stronger, not weaker. And Bloom is already growing at an extraordinary rate. The stock is up 44% since February 2026 as the market has started to understand this. My concern: Bloom Energy is still in growth mode and not yet consistently profitable. This carries more risk than Chevron. My takeaway: on-site power generation that is completely independent of the global energy crisis happening right now, up 44% since February and still has significant room to run as AI data center demand accelerates. This is a buy. Stock number 3, Exxon Mobil, ticker XOM. The CEO of Exxon just told the entire world that oil prices are going higher, and you can own a piece of that company right now. Exxon generated record operating cash flow in 2025. They have the strongest balance sheet in the energy sector, and unlike smaller oil producers, Exxon has the scale and diversification to weather volatility while still returning massive amounts of capital to shareholders through dividends and buybacks. Here is what makes this moment different. Exxon's CEO did not just give a vague warning. He said specifically that his company's production in the Middle East would decline by 750,000 barrels per day compared with 2025 if the strait remains closed through the second quarter. And he said there is more pain coming for oil markets. When the CEO of a company tells you his industry's prices are going up, you listen. My concern: Exxon is a massive company. It will not double. This is a capital preservation and dividend play, not a moonshot. My takeaway: the CEO just told you prices are going higher. The dividend yield is strong. The balance sheet is fortress quality. This is a buy for conservative investors who want energy exposure without taking excessive risk. Now let me show you 2 stocks that most people would not associate with an energy crisis at all, but I think they are among the best positioned companies for exactly this environment. Stock number 4, Palantir, ticker PLTR, current price around $144. I know what you are thinking. Palantir is a controversial stock. It trades at over 100 times forward earnings. Michael Burry is betting against it. The valuation is extreme by any traditional measure. All of that is true. And I am still going to tell you why it belongs on this list. Here is the reframe. Palantir does not just benefit from wars, it becomes essential during wars. The company's software helps governments and militaries make faster, better decisions in exactly the kind of chaotic environment we are living through right now. That is not a marketing claim. That is why the US Department of Defense has been expanding its Palantir contracts throughout this conflict. Revenue grew 70% year-over-year in Q4 2025. Analysts expect 74% growth in Q1 2026 when it reports on May 5th, which is tomorrow. Net income margins hit a record 43% last quarter, and here is the strategic reality. Palantir's software is now so deeply embedded in US government and military systems that replacing it would take years and cost billions. That is not a customer, that is a dependency, and dependencies compound. My honest concern, the valuation is extreme. At 100 times forward earnings, there is essentially no margin for error. If growth slows even slightly, this stock gets hit hard. Insiders have sold $435 million in shares in the last 3 months, with zero buying. That is a significant warning sign. My takeaway, this is not a stock for conservative investors. It is for investors who believe that AI-powered decision-making in government and defense is a decade-long secular trend, and that Palantir is the irreplaceable platform for that trend. If you believe that, the valuation, while painful, is justifiable. If you do not, stay away. Stock number 5, Micron Technology, ticker MU. Most people look at Micron and see a memory company that has nothing to do with an oil crisis. They are missing the bigger picture entirely. Here is the reframe. The Iran crisis is accelerating AI investment, not slowing it. Governments around the world are watching this conflict and concluding that AI-powered defense, logistics, and decision-making is now a national security priority. That means AI spending is going up, not down. And AI spending means more demand for the high-bandwidth memory that Micron makes and that nobody else in America produces at scale. Micron's entire 2026 HBM supply is already sold out. Their next-generation product is being pre-ordered before it even ships. Revenue guidance for next quarter is $18.7 billion with 440% earnings growth. And the stock trades at just 9 times forward earnings. 9 times forward earnings for a company with 440% earnings growth and sold-out supply for 2 years. My concern? Micron operates in a cyclical industry. If AI spending slows, Micron feels it, and the stock is volatile. My takeaway? 9 times forward earnings with 440% earnings growth and supply that is sold out through 2027 because of AI. The valuation gap between what Micron earns and what the market gives it credit for is one of the clearest mispricings in the market right now. Strong buy. Let me bring this all together. The market thinks the Iran crisis is over because there was a ceasefire. The CEO of Exxon Mobil says the market has not seen the full impact yet. Ship traffic through the Strait of Hormuz is at 5% of normal levels. 1 billion barrels of oil production has been lost, and the stockpiles that have been cushioning prices are running out. This is not over. It is entering its most dangerous phase for investors who are not paying attention. If I had to rank all 5 positions for new money today, here is exactly how I see it. Number 1 is Chevron. 39 years of dividend growth, improving cost structure, and Buffett-backed exposure to higher oil prices. Number 2 is Micron. 9 times earnings with sold-out AI memory supply through 2027. Number 3 is Exxon. The CEO just told you prices are going higher. Listen to him. Number 4 is Bloom Energy, on-site power generation that gets more valuable as the energy crisis deepens. Number 5 is Palantir, highest risk and highest conviction play on AI-powered defense becoming a permanent government priority. Here is the investing truth I want to leave you with. Every major crisis in history created two groups of investors: the ones who panicked and sold at the bottom, and the ones who understood what was happening, stayed calm, and bought the right assets while everyone else was running scared. The 2026 Iran crisis is not over. The full economic impact has not been felt yet, and the investors who position correctly in the next few weeks may look back on this moment as one of the best buying opportunities of the decade. You now have the information. The question is what you do with it. Disagree? Tell me in the comments. Which stock would you add? Which one do you think I am wrong about? Subscribe for weekly research on what is actually happening in markets. No sponsors, no fluff, just the analysis. See you in the next one.